According to DeFi Llama, DeFi TVL currently sits at $37.824 billion, and this is down from its previous all-time high at roughly 180 back in November of 2021. And chances are, if you're watching this video, you're generally bullish crypto and DeFi, you see the value in the space, but you understand that the products right now just aren't good enough. It's not creating enough value for people to want to deploy their capital on chain. And I'm going to start this monthly series of, okay, how does DeFi get back to its previous all-time highs in terms of TVL and eventually hit $1 trillion of TVL, right? And I'm going to do this video every single month until we get there. So hopefully I'm not dead by then. But this is going to be part one of hopefully a long series where, you know, at the start of every month, I'll monitor the trends, the narratives, and the fundamentals of DeFi, and, you know, how we can like reasonably get to all-time highs in TVL. And to answer the question, right, like how do we get there? I think all these things need to happen because most crypto, like DeFi applications, their TVL, it's denominated in crypto native assets, mostly in wrapped Bitcoin and also ETH. So if the price of these assets go up, then yes, TVL goes up. But also, another core, like very, very important part of DeFi is the stablecoin market cap. People deploy dollars as a unit of account and as a store of value. And right now the trend of stablecoin market cap is like down only. Maybe you can argue that we're kind of bottoming out here. But you know, you could have said the same thing back in like June of last year or like June of this year, where we put in a bottom, we bounced a little bit, went sideways, but you know, we ultimately put in new lower lows. And until blockchain applications can actually create like real use cases and value, I still think that, hey, like it's reasonable to expect this trend to continue going down or at least go sideways, but not up. And then like, there's like also this question of like, do crypto prices pump and then stablecoin market cap go up? Or does the stablecoin market cap go up and then crypto goes up, right? And I think it's more likely the latter than the former. There's like this prevailing narrative / thought that, you know, meme coins go up and then, you know, retail piles in, right? But that's also a very condescending way to view retail participants because we're all retail, right? We're all trying to figure this thing out as we go. And I think most people, right? And there's select people that only care about meme coins, but I think most people in the world will deploy capital into like financial applications if they see value in it and they get something out of it. So I argue that, hey, like stablecoin market cap goes up and then crypto like narratives and pumps can actually sustain and not the other way around. You saw this with Pepe where, you know, it hit like a billion market cap like immediately. And people were saying, oh my God, like this is going to lead to retail speculation. But no, like it's kind of like dying down. I mean, who knows, like maybe it has like a secondary pump, like, you know, like meme coin traders can do whatever the hell they want. But I focus more on DeFi and like dollar inflows, dollar outflows. And, you know, like this is not it, right? It's cool. Like, you know, this captures headlines and whatnot, but you know, it's not going to get people back into crypto and back on chain. So yeah, no narratives are sustainable if dollars are aren't flowing into the space. And it's not going to be meme coins. There has to be real value involved. And that's the problem, right? That's the core problem in crypto and crypto native applications. Most DeFi applications rely on people paying fees and those fees going to token holders. But if there's no new inflow, right? Basically, there's like this value destruction where you stake a token, you earn a yield, but that yield is coming from someone else, and maybe the protocol takes some of that, and then, you know, it's like the opposite of like a rising tide lifts all boats, right? A sinking tide like lowers all boats, and until people see the value of these applications, I feel like this trend is going to persist, and I think it's important to, you know, just be optimistic and think about, okay, what needs to happen for dollars to come back on chain? And for the past few months, I've been talking about this thesis that I have around like real world assets, and I'll lay out my like evidence or like my argument in this video. So you know, with the lack of the lack of positive sum games and crypto mostly being zero sum and negative sum, this poses a problem, especially when the stablecoin inflows are not going up. And there's a little reason, right, to leave money in crypto when you can just go to Fidelity and earn over 5% in short-term treasuries. You can earn 10, 20%, 30% yield in stablecoins, but it's not really sustainable. It's come from token inflation. And even if it is sustainable, if people think it's safe, people will pile into the opportunity and then the yields will collapse down to like 5, 6, 7%. And at that point, is it really worth the risk? Like the market is saying that it's not worth the risk. And like that's why the stablecoin market caps are going down. And, I don't like to admit this, right? I call myself a humble farmer, but, I do have some money in the, like certificates of deposits, like CDs on Fidelity, because, it's pretty good, right? I mean, let's be real with ourselves. Like, these are pretty good. It might underperform Bitcoin, it might underperform stocks, but if you're holding cash, instead of putting a bunch of money on chain, it makes sense to like just put capital here. And that's the core problem in crypto. So until on-chain yields can actually compete with off-chain yields, I don't really see money returning to the space. And we've learned over the past couple of months and the years that crypto native applications can't beat off-chain yields, right? On a risk-adjusted return basis. So if that's the issue, my thesis and my argument is that we have to bring off-chain yields on-chain, because DeFi and crypto can't survive 5% interest rates. And if we can tokenize these treasuries, right, these tokenized T-bills, and make them composable through DeFi, money Legos, composable smart contracts, then I think we can actually enhance those yields and compete with off-chain yields and like products that you can see in TradFi. And I think this needs to happen for DeFi to thrive. And also, right, for crypto to thrive, because right now, like I mentioned, there's no reason to like have money in crypto. So DeFi needs to create like financial products that, incentivize people to bridge money on chain. I mean, it's not going to be everyone, right? It's going to be a process, but we have to find ways for this to happen. And I think the first step is going to be with tokenized treasuries, T-bills. So let me kind of explore that further. And I talked about this a couple weeks ago in this video called DeFi Antifragility and the rise and the new DeFi 3.0. And I coined this term, and maybe this ages poorly, but I think I'm directionally correct with this idea where on-chain apps are not good enough. And the first step to creating value on blockchain is to connect the real world with on-chain, and then with like that, I guess, like by bridging like the two, you can actually create more value on top, and then that can actually lead to like the next DeFi bull market. And the poster child for tokenized treasuries is Maker, right? Maker owns roughly $2.3 billion in treasuries and cash equivalents, earning like roughly 4 to 5%-ish yield. And they're flowing, or they're taking these government interest payments, they're flowing it on chain, and they're basically essentially bridging the risk-free rate on chain, right? And I'll talk about a few DeFi strategies that can enhance this. And I argue that this is good because these are positive sum games, because with other DeFi apps, right, people are paying each other, negative sum games, not great. But if the yield comes from government interest payments and people are paying, these protocols fees to, capture that yield, then it actually creates, for positive sum games where like the DAO makes money, the token has a value accrual, and the user paying the fees also makes money. And this also, that fixes the stablecoin issue. So, yeah, I mean, if you've watched this channel, this thing called sDAI, which is staked DAI. So it's a liquid representation of DAI that's earning the risk-free rate at 5%. And this proposal passed on the 28th, where sDAI can now be used as collateral on AAVE, the premium money market in all of DeFi. And I've talked about this before, but AAVE has a stablecoin called Go. And I mentioned, hey, like you can use sDAI as collateral, earning 5%, borrow Go at 1.5%, and then loop it and then get like 10% yields on stablecoins. Pretty good. But since I made that video, AAVE, they have a new proposal to raise the borrow rate from 1.5 to 2.5%. I think this is smart. I mean, I think ultimately this is gonna go up to 4%, but I think they're gonna just have it be low, just so that they can like expand the supply of Go, because this is going to be their main money maker, right? AAVE as a protocol like barely makes money, but if they can issue their own stablecoin and charge like their own interest rate, this is going to be like their main revenue generator. So the AAVE DAO should do whatever in their power to grow the market cap of Go, and also to make sure that it trades at peg, so there's actual utility. And I did the math here. So let's say that you have sDAI as collateral, you borrow Go. sDAI is earning 5%, Go, the borrow rate is 2.5%, and you do this a 70% LTV, so loan to value. The max LTV is 77%, but like let's just be conservative, like 70% here. So if you loop this 3 times, where you have 100K of sDAI, borrow 70K of Go, swap it into sDAI, recollateralize it, borrow some Go, recollateralize it, and then you do this 3 times, right? So like every time you do the loop, you can borrow less and less, because like that's how over collateralized loans work. If you do this 3 times, Sure, you'll pay a bunch in gas fees because it's only on mainnet, but you can get roughly 9% APR APY, which is like pretty good. And I'm sure that in the future, there's gonna be different front ends that allow you to do this in one click. And as the liquidity profile grows on sDAI and Go, I'm sure this strategy will also be available on cheaper chains like L2s. So like I mentioned, right, this video isn't like, okay, like next week, like everything's gonna pump, right? It's more about, okay, like what needs to happen for DeFi TVL to grow, like thinking about it in like first principles, like fundamental basis. And I think this is step one, because where's the yield coming from, right? The yield is coming from off-chain government interest payments, which doesn't dilute. It's very sustainable. It's very scalable and predictable. And Maker makes money, right? As a result of this, AAVE makes money because people are paying 2.5%, and the user makes money because they make like 9% yields, right? Pretty good, positive sum games. Of course, there's risks in that, if sDAI goes down in value, then you can't be liquidated. But sDAI is literally staked DAI, right? It's wrapped DAI. So it's very unlikely it goes down in value. Go could appreciate in value, which might cause some liquidations, but that's also going to be pretty unlikely for the mechanisms that I'll talk about later. Because right now, this doesn't really work because Go is trading below peg. And I mean, obviously, there's like no liquidity mechanism or incentives to get this to like $1. So obviously, AAVE has to fix this, but they are making steps. To fix this issue. For example, there's this proposal right now to acquire Aura tokens from Olympus DAO for like roughly $500,000. And Aura is like the convex of the balancer DEX. So they can use the Aura voting power to direct emissions for their Go stablecoin to incentivize people to mint Go and then provide liquidity. Same goes for their treasury swap for USDT to CRV. We all know like what happened to CRV. Pretty crazy stuff. But with the voting power from these governance tokens, they're probably going to incentivize liquidity for Go, which should help the peg. But also there's also this new proposal called the Go stability module, because DAI has this thing called the PSM, the peg stability module. So where if DAI is trading at, let's say, $1.10 for whatever reason, anyone can take USDC and mint DAI 1-to-1 and then capture that 10% arbitrage. Go doesn't have that, but they're working on it right now. I have no idea when this is going to go live, but when it goes live, you can mint. So you can buy Go for, let's say, like 98 cents and then redeem it for like 1 USDC or USDT for like up to $5 million. So it's an audit. I'm not sure like when it's going to go live, but like maybe there's arguments to be made to like buy Go below peg and then like sell it when it gets when it gets back to peg. So AAVE is working on it. I'm not sure how long it's going to take, but like once these mechanisms are in place, I'm sure that these looping strategies are going to become more viable, and it's going to increase the entire stablecoin rate across all of DeFi. Because let's talk about how DeFi benefits, because like that's the whole point of the video. I've talked about this before, but like Maker is essentially the on-chain Federal Reserve, because the Fed, like in the real world, they set the risk-free rate, and then everything just has to adjust accordingly. And similarly, Maker is the on-chain Fed, because they're setting the risk-free rate of sDAI to be 5%. If you're a DeFi protocol and you can't beat 5%, then your token is going to go to zero, right? Like no one's going to deploy capital for your project because, sDAI is safer at 5%. And even like, if some random farm is paying like 8% yields in stablecoins, chances are like, sDAI is like probably worth it. And like that farm is not. AAVE makes money, right? Because people are willingly paying 2.5% to arbitrage these rates. So DAO makes money, and then the user makes money from the stablecoin yields. Like I said, like AAVE should raise the rates at some point, but I think they're just like keeping it low to bootstrap the growth. But even if it goes like 4%, I mean, that's still pretty good. And it's like a reasonable way to get decent yields on stablecoins on chain, and it's not reliant on pure Ponzonomics. So this is like also like a fun idea, and I'm not sure when it's going to go live, but just let's talk about it. So AAVE has this thing called the E mode, where if you're using like assets for collateral and borrows, you can actually enhance the LTV ratio. So if you're using stake DAI as collateral to borrow ETH, then the LTV is going to be at 77%. But if you use E mode, where you use sDAI to borrow like another stablecoin like Go, you can borrow up to 97% LTV, which is like actually insane. So hypothetically, right, if you use, if this is enabled and Go is trading like at $1, and like you loop it like 10 times at like an LTV of 90%, you can actually get to, the important thing here is like not the actual numbers and like the amount of leverage. It's more about, okay, like it's possible. And even if AAVE, right, increases borrower costs to like 4%, there's still going to be like incentives for people to loop things and then capture like 8 to 10% yields on stablecoins. And, you know, like this is a positive sum game because, you know, like who's the counterparty from the yield, right? It's the US government. And the user makes money, the DAO makes money. And this can actually result in net inflows on chain. Because I mean, technically, right, like no new retail participant is converting their fiat currency into USDC and bridging it on chain. However, technically, right, like if DAI supply expands, then that means that there's more DAI backing, and with the backing, Maker can buy more T-bills. And with more T-bills, there's going to be higher interest payments that can flow on chain, and those dollar inflows should create more value for on-chain DeFi users. And with enough time, as these strategies become more viable, and you know the size expands over time, I think it can actually put a stop in the bleeding of the stablecoin TVL. Like maybe it's not going to go up only, but like maybe we can like see like a basing out of the stablecoin liquidity, which I think is going to benefit the entirety of crypto. And you know, like Mark Zeller, who works for AAVE, you know, there's a lot of demand to use stake DAI as collateral. Like I mentioned, you can't do the Go looping thing right now because they're working on the peg. But you know, like there's a lot of demand because you know what you could do potentially is take stake DAI as collateral that's earning 5% and then borrow ETH, for example, and then deploy ETH into random farming strategies, and then you kind of have this delta neutral farm where you know you're literally like just borrowing ETH at let's say 3% to earn 10%, and your collateral is also appreciating in value, right? So it's not going to be like a mechanic to make people rich, but it's a good way to manage your portfolio and also people's their portfolio and like I guess their net worth and whatnot. And you know there's going to be more integration. So the most important thing for me is for like my Maker and like my real world asset thesis is integrations of sDAI for other protocols. You know, the AAVE integration is good. And then there's also like integrations with other DeFi applications like Pendle. This is like the yield trading platform where, you know, you can provide liquidity for sDAI and then earn like 12%. There's like no reason to trade the yield because the yield is fixed at 5%, but I guess they're setting themselves up for the future. And technically, right, like if you can provide liquidity for like sDAI and DAI, and if there's like more opportunities like this, and like more demand, there's like more demand for DAI, and there's like more and more DAI that's not being staked, then technically that's also going to increase the profitability of the Maker DAO because they're having to pay out less yield. It's kind of similar to how, you know, Tether has like billions of like people using, or like billions of market cap, and like no one gets, like if you're holding Tether you don't get any yield, right? But the Tether company, the parent company, is like buys T-bills with it, and then they capture like billions of dollars in quarterly profits every single quarter. It's ridiculous. I think that at some point, if sDAI grows in market cap, other stablecoin issuers like Circle and Tether, they're going to be forced to pass down the risk-free rate to its token holders. Because if you look at it right now, so this is like make or burn. Since the, I guess in the past couple of months, the DAI market cap has gone up by roughly $1 billion ever since the DAI savings rate was introduced. And I do think that this was the bottom in the DAI market cap for like the next 6 to 12 months. And the most important metric to me is the amount of DAI in the DSR, because this is proof that people are seeking out safe stablecoin yields. And as there are more integrations, this should increase. And then that should also help like the entire DeFi ecosystem. You don't even have to like Maker the token, but if you're bullish DeFi, you should cheer this on, right? Like this has to go up in order for DeFi to recover, or at least that's my working thesis, I suppose. So, you know, when it comes to like my DeFi framework, you know, I would even say that like without tokenized treasuries, like DeFi in its current state is like mostly dead, right? It's like negative sum. There's like no dollars coming in. Something has to change. Maybe it's not like, maybe I'm wrong with like the actual like Maker thesis, but I don't think I'm wrong in thinking that something needs to change. And with the way I see it, the current state of markets, I think the most likely path is through tokenized T-bills. And by bringing treasury yields on chain, DeFi can offer superior products that can lead to more innovation. So, you know, that's going to be like, you know, in the following weeks and months, that's kind of my thesis. I think, on-chain applications, like on-chain native applications, just aren't good enough. It's not creating enough value. Therefore, the types of products that's going to get mass adoption is going to be, things that bridge the real world with like the on-chain world. And Friendtech, right? The tokenized people social token project is also like a real world project, right? Because I have like my Friendtech shares and I'm like a real world asset technically, right? Like you're a real world asset, like we're all real world assets. So like I'm not like really like I'm not like purely focusing on like real world assets like as like a DeFi sector, but I'm also focusing it on like a macro scale for like how crypto can actually reach a million and like a billion users. Because I talk to my girlfriend, I talk to my friends, like they all think crypto is a scam, and like I don't really blame them. And until there's like actual like apps that people see value in, that's still going to be the case. So I've been writing about like this idea, right? Like the real world assets and also like decentralized physical infrastructure networks. So like Akash is like trying to do like decentralized cloud or like decentralized Amazon Web Services, and they're also pivoting to like the AI space. And we've talked, like we've written, like my team and I, we've been bullish maker for like 2 months now. Oh yeah, and like by the way, like if you want like this research content, like feel free to check out the Substack. It's completely free, right? I'm not going to charge for it, and we put out like 3 newsletters every single week, so I think it's pretty good. But if you want like premium content where I make additional videos every single week, check out the premium Discord. Link will be in the description below. But to wrap up this video, let's talk about the path forward. So how does DeFi, right? Like answering the original question, how does DeFi get to a trillion TVL, and then DeFi 3.0. If you go to the DeFi Llama and you go to the categories section here, you see that, okay, these are the DeFi categories and the combined TVL. There's like double counting here, right? Because there's like liquid staking derivatives that's being provided into liquidity on like lending platforms. But it's like generally it's going to be like this. Real world assets is like actually number 7 because it's not accounting for Maker's $2.3 billion. But I do expect this entire RWA sector through tokenized T-bills to eventually hit like top 3 in TVL. I don't really see a world where like it doesn't happen unless there's like some like really faulty regulation, which is always a risk. But I've addressed that in my past videos as well. Liquid staking, I guess, benefits is like if Ether goes up, but I think for Ether to go up, I think we need to see like more assets to be tokenized on chain and therefore create more value. So going back to the slides here. So DeFi 1.0, right? Just thinking about where we've been and where we're going. This happened in 2020. This started the DeFi boom, where Compound introduced liquidity mining, and then it captured the imaginations of a lot of people, including myself. Right, this is like when I onboarded DeFi over 3 years ago, where I was like, wow, like this is amazing. I can actually use these applications. I'm making money, and then it was hyper speculative. No one knew what they were doing, and I mean, I even argued no one still knows like what they're doing, like including myself now. But we're all experimenting and like forming different ideas and theses, and then with the DeFi boom or like crypto boom, DeFi 2.0, like this token or this phrase was coined, and this is like peak bull market like phenomena, right? It was like Olympus DAO, 3.3, Wonderland Time, right? Like Frog Nation. It wasn't really sustainable, but it led, like DeFi 1.0 led to capital inflows, and then that capital inflows led to unsustainable, purely euphoric Ponzonomic stuff. But I think going back to, I guess, first principles, like going back to like fundamental roots, I think, in this high interest rate environment, it's not enough to just hope for money to come back. I think we need, like, if we're going to see like the next cycle in terms of like bull market like shenanigans, we need to create actual value, and I think it's going to come in the form of real world assets where if interest rates are high, even if the Fed raises rates like 6% for example, DeFi can compete because we're tokenizing the risk rate on chain, right? And we can pay out 6% easily and then like add yield on top through tokens or incentive, like leverage or like whatever. But if the Fed cuts rates to, let's say, 3%, maybe the real world asset narrative weakens a little, but like that's probably going to result in more dollars coming into chain because people want to speculate on higher risk assets. And then I'm making a case that like through the tokenization of treasuries, DeFi can survive both high and low interest rate environments. And that's really, really important because crypto just can't survive right now. So without DeFi, I don't think crypto survives. Maybe that's controversial, but that's my personal views, right? Because I argue that right now, crypto is resilient, but it's not really anti-fragile. Maybe Bitcoin is anti-fragile, but it remains to be seen. But if you think about DeFi, I think DeFi is in like a pretty fragile state. It's resilient and fragile, where, you know, it's suffering and breaking from external sources like high interest rates. But I think we need to get to this anti-fragile state, and I think it has to be via real-world assets. Who knows? I could be wrong here. And, you know, right now, the DeFi TVL, 37.8 billion. Can we ever get to its previous all-time highs? I think so. I mean, that's why we're all still here, right? That's why you're watching this video, because we think that's going to happen. Of course, maybe like, you know, I'll make a DeFi path to a trillion TVL part 70 or part 69, and we're still at like 50 billion TVL. And at that point, all hope will be lost probably. But if you think, right, like there has to be more innovation, there has to be better products, and I think we're slowly getting there. I give my example with AAVE and Maker. I'm sure other like novel types of applications will come up, but that's currently how I see things. So that's gonna be it for me. 26. Okay, like that's pretty good. And you know, the core thesis that I have is for crypto to come back, we need to see stablecoin inflows, and for us to see stablecoin inflows, we need to bridge the off-chain yield and bring it on-chain. And if I'm gonna, I mean, like if I am right on this thesis, then like technically like DeFi can't, or crypto can't survive, or like DeFi can't survive if it's like not for projects like Maker. So like that's why like I'm bullish Maker. I could be wrong, and like I could totally change my views like in a month or two. But in the meantime, in this type of environment where, you know, like crypto prices are, you know, going up and down, like ETF, no ETF, like whatever. I mean, Maker is even up today, right? It's like, I actually have no idea. I've often joked that like one Maker equals one ETH, right? Because like that's parity, where price of Maker is 1100 and ETH is like 1600. So, you know, like my bull case is for it to get to parity, right? One ETH, one Maker, parity. It's at 0.69. That's very convenient. This looks pretty bullish. We'll see. And you know, Maker is not really like a sexy asset, right? But you know, the system buys back its own token as long as the system surplus is over $50 million. So you know, every 2 hours it buys back $20,000 worth of Maker, and accrues protocol and liquidity. And then like, you know, so the system has like $1.7 million worth of buy pressure left. So, you know, in this type of market, when the sentiment is like really bad, it's good to know that, okay, like there's like some buy pressure. There was a period where it got back below 50 million, and then like the buyback stopped. But hey, like, you know, like the interest payments came online, and like now it's being depleted. And I'm sure that in the future, like it's going to go below 50 million. People are going to sell tokens, but then like randomly, like, you know, the interest payments hit the chain, and then, you know, it's going to buy back its own token. So it's like a pretty defensive play. It's probably going to underperform in like a bull market, but I still like it as an asset right now. But, you know, just understand that, you know, crypto changes so fast that maybe my tune changes. But, you know, I've been bullish Maker for like 2 months now. So we'll see, right? We'll definitely see. So thank you guys for watching. Let me know what your thoughts are on the series. Hopefully, you know, I'm not going to die and before we get to a trillion. But I'm making a bet that at some point, right, we'll hit like all-time highs, we'll hit a trillion, and then we can look back on this video on September 1st and be like, wow, remember when I was making videos when the DeFi TVL was 37 billion? That's crazy, right? Like, oh my God, like what an opportunity. But it definitely doesn't feel like it, right? But anyways, thank you guys for watching. See you guys another time, and hope you enjoyed the video. Bye-bye.